Hi, I'm Rob Brown, real estate broker at Fantastik Realty Inc. How would you like to save millions in taxes legally while investing in San Diego's supply-constrained coastal real estate market and owning stunning beachfront property, a generational investment opportunity? Today, I'll walk you through a $5 million deal in coastal San Diego using the short-term rental loophole, cost segregation, and bonus depreciation to slash your taxes and boost returns. This powerful tax strategy lets investors offset earned income with property losses, and I'm here to guide you every step of the way. Let's dive into this 6-minute deep dive. The short-term rental loophole, found in IRS Reg Section 1.469-1T E3IA, is a game changer. It allows properties rented for an average of 7 days or less, like Airbnbs, or 30 days or less with significant services to be treated as non-passive businesses. This means losses can offset your W-2 or other earned income, even if you're not a real estate professional. Unlike the real estate professional status, which requires 750 hours in real estate, this loophole is accessible to high earners like doctors or lawyers. The tax code lists 6 exceptions to passive rental activity, but the 7-day rule is the most common for short-term rentals in high-demand areas like San Diego's coast. This loophole traces back to the 1980s. Before the Tax Reform Act of 1986, anyone could offset active income with rental losses. High earners, like professionals, use this to lower taxes, sparking controversy. The act introduced Section 469, making rentals passive by default to curb tax shelters. In the mid-1990s, lobbying led to the real estate professional exception. But the STR loophole emerged as platforms like Airbnb made short-term rentals widespread. Originally meant for hotels, it's now a powerful tool for investors, upheld in tax court cases. Let's walk through a $5 million beachfront property deal in coastal San Diego, say a La Jolla villa, step by step to see how it works. Step 1. I leverage my expertise to find the perfect short-term rental property. San Diego's coastal market is supply-constrained, with high demand in areas like Coronado and Pacific Beach. I ensure the property meets the 7-day or less rental RE and has strong cash flow potential, projecting excellent returns based on local rental data. Step 2. You purchase the property for $5 million. You put 20% down, $1 million, and finance $4 million with a mortgage. I coordinate with lenders to secure favorable terms, and we cover closing costs, getting you set for ownership. Step 3. We engage a real estate CPA to conduct a cost segregation study. This reclassifies 20 to 30% of the property's value, let's say 30%, or $1.5 million, into shorter depreciation schedules. Items like appliances, furniture, and landscaping shift from a 39-year depreciation life to 5 or 15 years, accelerating your deductions. Step 4. We apply 2025's 40% bonus depreciation to that $1.5 million, allowing a $600,000 deduction in year 1. Bonus depreciation is phasing out, down from 100% in 2022 to 20% in 2026 and gone by 2027. So acting now maximizes savings. Even post-2027, 5 and 15-year depreciation still offers benefits. Step 5. You meet material participation tests to ensure non-passive status. The easiest is spending 100 hours on the property, managing bookings, coordinating cleaners, or marketing, while ensuring no one else, like contractors, spends more. Other tests include 500 hours total or doing nearly everything yourself. I'll help you track hours using property management software to withstand IRS audits. Now, the tax savings. If you earn $2 million annually at a combined federal and state tax rate of 45%, you'd owe $900,000 in taxes. The $600,000 deduction lowers your taxable income to $1.4 million, reducing your tax bill to $630,000. That's $270,000 saved in year 1, beyond taxes. The property generates rental income, San Diego's coastal STRs often yield high occupancy and appreciates in a market with limited supply, building long-term wealth. To qualify, you must avoid common mistakes. First, ensure the average stay is 7 days or less. Don't manipulate leases, as extensions count toward the original stay. Second, limit personal use to under 14 days or 10% of rental days, or it becomes a personal residence, blocking losses. Days spent on repairs don't count as personal use, which I'll help you leverage. Third, track contractor and cleaner hours to prove your 100-hour participation. Fourth, comply with San Diego's strict STR regulations. I'll verify local rules to keep your investment legal. Finally, don't misclassify the property. I'll ensure it meets IRS criteria. A Loophole's future looks stable. Designed for hotels, it's unlikely to be closed soon due to legislative complexity, with no proposed changes as of now. However, it's US-centric. Foreign properties qualify but can't use bonus depreciation, relying on slower alternative depreciation system schedules, weakening the strategy. At Fantastik Realty Inc., I'm your partner in this journey. I'll source prime coastal properties, connect you with a savvy real estate CPA and attorney, and guide you through pitfalls like untracked hours or regulatory bans. My team ensures your STR maximizes cash flow and tax savings while appreciating in San Diego's elite market. This isn't just an investment, it's a lifestyle, letting you own a piece of paradise. Ready to save big and own beachfront real estate? Contact Fantastik Realty Inc. today for a free consultation. Like, comment, subscribe, and let's seize this generational opportunity to build wealth in coastal San Diego. Disclaimer: I am not a certified public accountant, CPA, or attorney. The information provided in this video is for informational purposes only and should not be considered tax, financial, or legal advice. Before implementing any strategies discussed, including the short-term rental loophole, cost segregation, bonus depreciation, or investment decisions, please consult with your CPA and attorney to ensure they are appropriate for your specific financial and legal situation.